Warren Buffett's recent move to sell 13% of his Apple holdings, or about $20 billion, has sent shockwaves throughout the finance world. Apple at one point made up around 50% of Berkshire's portfolio and was considered by many to be its key asset. This significant sale has sparked speculation about the reasons behind his decision. Is Warren foreseeing serious economic challenges ahead? Did he uncover something in Apple's recent report, or could there be another motive behind his decision to part with one of his favorite positions? Let's not forget that when Warren considers something special, he tends to keep it for decades. For example, he's owned Coca-Cola for over 36 years and American Express for 32 years. These are companies that he considers a forever holding, and in the case of Coca-Cola, he's been pretty vocal that he would never consider selling even one share of the company. In July of 2013, Warren Buffett actually attended a Coca-Cola event and told the audience that he would never think of selling any part of this business. You can hear him say that here.
We own 400 million shares of Coca-Cola stock, as you know. We've never sold a share. And I wouldn't think of selling a share.
If Warren Buffett is so dedicated to Coca-Cola almost religiously, why would he treat Apple any differently? Apple has been the crown jewel of Berkshire Hathaway's portfolio, driving much of its equity gains over the last decade. So why sell such a successful asset? To fully understand the significance of this transaction, we need to delve into its historical context. While this move might be seen as a routine adjustment, it stands out given Berkshire's legacy and Buffett's investment style. The first thing you need to understand is that the Apple and Berkshire narrative stands out as one of the most remarkable in financial history. It's astonishing to think that not too long ago, in April 2003, Apple shares were trading at just 20 cents. Then came the iPhone, a game changer that reshaped the world as we know it. Despite Apple's rise, as recently as 2013, Berkshire Hathaway wasn't keen on the tech giant. Charlie Munger famously remarked in a Reuters article, "You could hardly think of another business that is more un-Berkshire-like than Apple." Yet 3 years later, both Munger and Buffett changed their tune, acquiring 39 million shares. This stake grew significantly over time, eventually comprising nearly 50% of Buffett's extensive multi-billion-dollar portfolio, hands down becoming its most important equity asset. So when Buffett decides to shed nearly 13% of this substantial slice of the prized pie, it naturally prompts everyone to wonder, why now? Apple's stock price has remained robust, rising about 270% in the past 5 years and nearly 5% over the last year. Despite fierce competition, Apple's brand remains resilient. One of the most surprising parts of Warren Buffett's recent sale is its timing. Apple just announced a $110 billion stock buyback plan. This strategy will decrease the total number of outstanding shares, which theoretically should increase Berkshire Hathaway's ownership stake without any additional investment. So why would Buffett sell now when the buyback plan should, in theory, make Berkshire's existing shares even more valuable? Well, he was asked this question directly during this year's conference, which happened just a few days ago, and his answer was well over 9 minutes long. You can listen to the whole response by clicking the link in the description, but for the sake of this summarized video, I just wanted to get to the main point, and this clip really showcases that. Take a listen, especially to the ending, as he explains why.
American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. It's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math or you learn a little more physics. But investments, you don't really have to do that. You really have to have your mind set properly. So we will end up, unless something dramatically happens that really changes capital allocation, a strategy. We will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive.
So as you just heard there, Warren essentially tells the listeners that he still loves Apple, American Express, and Coca-Cola, but the reason he's trimmed the position is to build the already massive cash pile he has sitting on the sidelines. It's sort of a bizarre response when you think about it logically, and it signals the fact that right now as we speak, Warren is at least valuing the cash as a better opportunity than his supposed favorite business. But there is more to the story. He later goes on in his response to explain taxes. What he prefaces this response with is the fact that in the past, the capital gains tax on businesses like his has been as high as 50%, and that today's rate of 21% is quite low when looking at the history. He follows it up with this final quote, and this quote sort of gives us that last piece in understanding the sale from his perspective.
And they can change that percentage any year, and the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely, and the government wants to take a greater share of your income or mine or Berkshire's. They can do it, and they may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it.
If you read articles about the recent sale of Apple shares by Berkshire Hathaway, many believe Warren Buffett made this decision for tax reasons. However, this explanation doesn't hold up if you think about it. Taxes are only paid when shares are sold, so if Buffett sold to avoid higher rates in the future, that suggests he intended to sell anyway. And if the rationale is that he wants to build a larger cash position, then we're assuming that he finds cash currently more valuable than his supposedly favorite stock, Apple. I know some people might say I'm just a fear-mongering speculator, but let's be honest, even if Warren Buffett didn't like Apple's short and long-term prospects, he wouldn't publicly admit it. With Apple comprising nearly 50% of Berkshire's portfolio, no one with such influence would ever say something that might damage the stock's value. Imagine if he answered the question with, "I believe Apple's business is slowing down and we're looking to liquidate our position as we don't foresee positive things ahead." Such a statement would crater the stock and potentially cause a meltdown, damaging not just his company and investors, but also impacting the broader market. Buffett understands his influence and his responsibility to shareholders. He doesn't prioritize absolute honesty in answering these questions. Instead, he crafts responses that protect his interests and benefit his shareholders. The only reasonable argument, in my opinion, is that he's trying to diversify, as having nearly 50% of your portfolio in one company is a bit risky, but if that was the case, why not just say it? Part of me believes he doesn't believe in Apple or the broader market in the long term and sees trouble ahead. He might not be fully disclosing his reasons for selling Apple shares to prevent triggering a market sell-off that would hurt Berkshire's holdings. It would be in his best interest to protect his strategic advantage by keeping competitors in the dark and maintain investor confidence by emphasizing positive aspects rather than causing panic. Keeping his rationale confidential ensures stability in the market and protects his shareholders' interests. Let me know what you think in the comments below, and as always, please make sure you hit that like and subscribe button if you enjoyed it.